In 1877, Cornelius Vanderbilt died the richest man in America. His fortune, adjusted for inflation, was somewhere north of $200 million. In today's dollars, over $3 billion. He didn't just build wealth. He built an empire of railroads and steamships that controlled how an entire nation moved. 96 years later, in 1973, 120 of his descendants gathered at Vanderbilt University for a family reunion. Not one of them was a millionaire. Let that sink in. A $200 million fortune, gone, across 4 generations, while the family that built it threw some of the most extravagant parties in American history. Now here's the part nobody talks about. At the exact same time, the Vanderbilts were building 10 mansions on Fifth Avenue. Another family, quieter, more boring, almost invisible by comparison, was doing something completely different with their money. They weren't buying yachts. They were buying land, setting up legal structures most people have never heard of, and building something designed to survive not 1 generation, not 2, but forever. That family is still wealthy today. The Vanderbilts are not. What did they know that the Vanderbilts didn't? What does old money actually do with its money that's so different from what you see on CNBC, in the latest investing app, or from your favorite finance influencer? That's what this video is about. Not stock picks, not crypto. The actual documented multi-generational playbook of how old money protects and grows wealth, and why almost nobody on YouTube ever explains it. Because frankly, it's not exciting enough to sell you a course. Stick around, because by the end of this video, you'll understand a portfolio philosophy that's centuries old, still in use by the wealthiest families on the planet, and almost completely absent from mainstream financial advice. Let's define some terms, because this matters. New money, in the way Wall Street and finance media usually talk about it, means making money. Stock picks, growth, returns, beating the market, this quarter's earnings call. It's offense. Old money plays defense first. The old money mindset isn't built around the question, how do I get rich? It's built around a completely different question. How do I make sure this never disappears, no matter what happens to the economy, the currency, the country, or my grandchildren's decision-making skills? That single shift in question, from growth to permanence, changes everything about how a portfolio gets built. It changes what counts as an asset, what counts as risk, and what counts as success. And here's the uncomfortable truth. Almost none of what gets marketed to retail investors today reflects this mindset. You're told to maximize returns. Old money is obsessed with minimizing the chance of ruin. Those are not the same goal, and they don't lead to the same portfolio. We're going to walk through 8 pillars of what's often called the old money portfolio. The actual asset classes, legal structures, and philosophies that have kept certain families wealthy for 100, 200, sometimes 300 years. Some of this you can use directly, even with a modest amount of money. Some of it is mostly relevant if you're already wealthy. But understanding all of it will change the way you think about your own financial life. If that sounds useful, hit subscribe now, because this channel breaks down the financial systems the wealthy actually use, not the ones sold to the rest of us. Let's get into it. The first rule, don't lose the money. There's a quote often attached to Warren Buffett. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Whether or not he was the first to say it, it captures something real about how compounding actually works. Here's the math old money families understand instinctively. If you lose 50% of your portfolio, You don't need a 50% gain to get back to even. You need a 100% gain. Losses are mathematically more destructive than gains are constructive. This is sometimes called the volatility drag, and it's the reason capital preservation isn't just a conservative attitude. It's a mathematical strategy. Multiply that math across multiple generations, and you get something even more important: time horizon. A hedge fund manager thinks in quarters. A pension fund thinks in decades. An old money family thinks in centuries. When your time horizon is forever, the entire calculation of risk changes. A 2008-style crash that wipes out 40% of the stock market for 2 years is a rounding error if your family has been investing since 1890, if you survive it. The goal isn't to avoid every storm. The goal is to build a structure that can never be capsized by any single storm. Ever. This is why old money portfolios look so boring from the outside. They're not trying to beat the S&P 500 this year. They're trying to never have a year so bad that the family has to start over. Those are fundamentally different games, and they require fundamentally different assets. So, what actually goes into a portfolio built around permanence rather than performance? Let's go through it, piece by piece. Land, the oldest asset class in human history. Long before there were stock markets, there was land, and old money families never really stopped believing in it. This isn't nostalgia, it's math. According to the NCREIF Farmland Index, the industry benchmark that's tracked institutional-grade U.S. farmland since 1990, American farmland has delivered roughly 10% average annualized returns over more than 3 decades. That's comparable to, and in some multi-decade stretches, has actually outpaced the S&P 500. But here's the part that should really get your attention: the volatility. Standard data going back to the early 1990s puts farmland's annual volatility at around 6 to 7%. The S&P 500, over a comparable stretch, has volatility closer to 17 to 18%. Public REITs are similarly volatile, around 18%. So you're looking at an asset class that has produced stock market-like returns with roughly a third of the bumpiness. Why? Because farmland doesn't trade on a screen where panic and headlines can move the price every 5 minutes. It's appraised quarterly, based on actual productive value, what the land can grow, what it can be leased for, what the food the world needs is worth. During the 2008 financial crisis, while the S&P 500 was in free fall, the NCREIF Farmland Index actually posted modest gains. Land doesn't care about a banking crisis. People still need to eat. There's also a structural reason families gravitate to land. There's a fixed supply of it, and that supply shrinks slightly every year due to development, while global food demand only grows. Scarcity plus rising demand is the single oldest formula for long-term appreciation that exists. This is also why you'll find that almost every old, landed family in history, British aristocracy, Southern plantation families, Western American cattle dynasties, European nobility, built their fortunes around enormous tracts of land they never intended to sell. Land was never meant to be a trade. It was meant to be the bedrock. Timberland works on a similar principle and is part of the same family of real assets. Old Money Loves, Yale's own endowment, which we'll get to shortly, has held forestry investments precisely because trees, unlike stocks, keep growing in value whether or not anyone is paying attention to the market that week. If timber prices are low, you simply don't cut down the trees this year. Try doing that with a stock that's down 30%. The modern, accessible version of this for everyday investors is farmland REITs, farmland investment platforms, or even just owning a small parcel directly. The point isn't that you need to buy 1,000 acres tomorrow. The point is to understand why land has survived as a core wealth preservation asset for literally thousands of years, while plenty of hot asset classes have come and gone. The trust, the legal architecture, nobody talks about. Here's something that almost never gets discussed in mainstream personal finance content, because it's not sexy and it requires lawyers. The single biggest reason old money stays money isn't usually the investments themselves. It's the legal box those investments sit inside. Think back to the Vanderbilts. Compare them to John Jacob Astor, a real estate magnate who became wealthy around the same era. Astor set up what's sometimes called a 50-50 trust structure, splitting his fortune between his children and grandchildren, and requiring future generations to do the same. The Commodore, Cornelius Vanderbilt, did the opposite. He left the overwhelming majority of his fortune to a single son, with no real structure governing how it would be managed or protected going forward. One family used law to control the future. The other handed over a blank check. The modern version of this tool is called a dynasty trust, also known as a perpetual trust or generation-skipping trust. And the mechanics are genuinely fascinating. Normally, under Old English common law, there's something called the rule against perpetuities, which forces a trust to terminate roughly 21 years after the death of the last beneficiary who was alive when the trust was created. In plain English, trusts were designed to eventually end and pay everyone out. But starting in the 1980s, a handful of U.S. states, led by South Dakota in 1983, began abolishing that rule entirely. Today, states like South Dakota, Alaska, Delaware, Illinois, New Hampshire, and a few others allow a trust to legally exist forever. Nevada allows trusts to run for 365 years. Wyoming allows 1,000 years. These states compete with each other for this business because trust companies bring enormous fee revenue, and the side effect is that wealthy families can now build a legal vehicle that, in theory, never has to distribute its core assets to any single generation, ever. Why does this matter so much? 3 reasons. First, taxes. Every time wealth passes from a parent to a child through a normal inheritance, it can be hit with estate tax, gift tax, and a specific tax called the generation-skipping transfer tax, designed specifically to stop families from dodging estate tax by skipping a generation. A properly structured dynasty trust uses the available tax exemptions once when it's funded, and then the assets, and all future growth on those assets, can pass down through generation after generation without being re-taxed every single time. The compounding effect of not losing a chunk of the portfolio every 20 or 30 years is enormous over a century or more. Second, creditor and divorce protection. Trust assets generally aren't considered the personal property of a beneficiary in the way a checking account is. That means they're typically shielded from lawsuits, business failures, and, importantly, divorces. A beneficiary can benefit from the trust's assets for their whole life without a creditor or an ex-spouse ever being able to seize the underlying capital. Third, control beyond the grave. A trust can specify exactly how money is used: health, education, maintenance, support, rather than handing a 22-year-old a check for 8 figures. This is frankly an attempt to solve the exact problem that destroyed the Vanderbilts. Heirs who never developed the discipline to manage wealth because they never had to. This is the part of the old money playbook that's almost entirely invisible to the public because trusts are private documents, not Instagram posts. Nobody photographs a dynasty trust, but ask any serious estate attorney and they'll tell you. The legal wrapper around the money is often more important to multi-generational survival than the investment returns inside it. Quick gut check. If this kind of behind-the-scenes financial structure is new to you, drop a comment with the one thing that surprised you most so far. I read these, and they shape future videos. Owning the business, not just the stock. Here's a distinction that gets lost in most investing content. There's a difference between owning a share of a public company and owning the company itself. Old money has historically preferred the second. Many of the wealthiest, longest-surviving family fortunes in the world were never built by trading securities. They were built and sustained by owning operating businesses directly: a bank, a shipping line, a manufacturing concern, real estate development, an insurance company, a hotel group. And critically, when these families do invest outside their core business, they overwhelmingly favor private equity and direct ownership stakes over publicly traded stock. Why? A few reasons that matter. Public markets are priced every second by millions of strangers reacting to headlines, interest rate decisions, and quarterly earnings surprises. That price is often disconnected from the actual long-term value of the underlying business. Private ownership removes you from that noise. You're not forced to mark your business to a panicked market on a Tuesday afternoon. You simply own the cash flow it generates, year after year, regardless of what the news cycle is doing. There's also something called the illiquidity premium. Because private investments can't be sold instantly, they typically need to offer a higher expected return to compensate investors for being locked up. For a family with a multi-generational time horizon, illiquidity isn't really a downside. It's a feature. They were never planning to sell next year anyway. This is also where modern family offices come in, and the scale of this part of the financial world might surprise you. According to Deloitte's Family Office Insights research, there are now an estimated 8,000 plus single-family offices globally, managing a combined $3.1 trillion or more in assets, with that figure projected to grow to over $5 trillion by 2030. UBS's own Global Family Office report found the average family office in its survey managed around $1.1 billion on behalf of families with an average net worth of roughly $2.7 billion. These are essentially private in-house investment firms that exist for one family, doing exactly what we're describing in this video: structuring direct ownership, private equity, real assets, and trusts, all under one roof, with one multi-generational mandate. And it's not a new invention. The very first modern family office is generally credited to John D. Rockefeller, who set one up in 1882, specifically to manage and preserve the family's wealth beyond his own lifetime. That's not a coincidence. It's the exact same instinct we've been describing this whole video. Build something designed to outlive you. The Yale model. When institutions copied old money. Here's a twist you might not expect. Some of the most sophisticated old money portfolio, thinking of the modern era, didn't come from an aristocratic family at all. It came from a university endowment. In 1985, Yale University hired an economist named David Swensen to run its endowment. At the time, like most institutional funds, Yale held the majority of its assets in conventional U.S. stocks and bonds. Swensen tore that approach apart. Over his 36-year tenure, Swenson shifted the bulk of Yale's portfolio away from public stocks and bonds and into what's broadly called alternative assets: private equity, venture capital, hedge funds, real estate, and natural resources like timberland. By the time of his passing in 2021, only around 14% of Yale's endowment was sitting in conventional, directly held public equities. The rest was spread across illiquid, alternative holdings most retail investors have never had access to. The results speak for themselves. Yale's endowment achieved an annualized return of roughly 13.7% under Swenson, outperforming a traditional 60-40 stock and bond portfolio by about 4 percentage points per year, compounded over more than 3 decades. Run that math out across 36 years, and the difference isn't incremental. It's the difference between a fund worth tens of billions and one worth a fraction of that. This became known as the Yale Model, or the Endowment Model, and here's why it matters for our topic. It's essentially the institutional, formalized version of exactly what old money families have been doing informally for centuries. Heavy weighting toward illiquid, real, productive assets, minimal reliance on public markets, a time horizon measured in decades, not quarters. Swenson himself argued the advantage of illiquid markets wasn't necessarily that they're inherently safer. It's that there's far more opportunity for skilled, patient investors to find mispriced value in markets where impatient money can't easily participate. Now, an important caveat, because we promised you facts, not hype. Financial researchers have pointed out that a meaningful share of Yale's outperformance came not just from which asset classes Swenson chose, but from the unusually skilled manager selection team Yale built around those choices, something genuinely difficult for an individual investor, or even most institutions, to replicate. Plenty of pension funds and endowments tried to copy the Yale model's asset allocation directly and didn't get anywhere close to Yale's results, precisely because the allocation was only part of the story. So the lesson here isn't go buy private equity and copy Yale exactly. The lesson is the underlying philosophy: diversify away from a total reliance on public markets, lean into your own time horizon as a structural advantage, and understand that the most boring, illiquid corners of the investing world are often exactly where old money and the smartest institutional money has chosen to live. Passion, assets, art, wine, watches, and the quiet store of value. Here's a category that looks frivolous from the outside, but plays a very specific role in the old money playbook: art, fine wine, rare watches, classic cars, even rare whiskey. Knight Frank, the global property consultancy, publishes something called the Luxury Investment Index, tracking a weighted basket of 10 of these passion asset categories. Over the past decade, that index has shown roughly 70% cumulative growth, and individual categories have done even better. Rare whiskey, oddly enough, has been the single strongest 10-year performer in the entire index in several recent reports, with cumulative gains well into the hundreds of percent, occasionally driven by headline-grabbing single sales, like a rare bottle fetching millions at auction. Fine art has had years where it led every other asset class in the index, including a year it rose 30% in 12 months. But here's the key thing to understand. Old money families don't generally buy art because they're trying to flip it for a profit next year. They buy it for 3 more durable reasons. First, it's a store of value that's completely outside the financial system. A painting doesn't depend on a bank, a currency, or a stock exchange to retain worth. In times of currency instability or political upheaval, which, across 200 or 300 years, every family eventually faces. Physical, portable, internationally recognized value can matter more than a brokerage statement. Second, it functions as a diversifier with very low correlation to financial markets. Art prices don't move because the Federal Reserve raised rates. They move based on a completely different set of dynamics tied to scarcity, provenance, and collector demand. Third, and this is the part that rarely gets discussed publicly, passion assets like art can be extremely tax-efficient tools for transferring wealth between generations, partly because valuing a unique object is far less precise than valuing a publicly traded stock, and partly because many jurisdictions offer specific tax treatments for charitable donations or long-term holds of fine art and collectibles. None of this means you should run out and buy a Picasso. It means understanding that a tiny slice of even a modest portfolio, something tangible, durable, and disconnected from the stock market, has historically been part of how families that have survived centuries of financial turmoil think about diversification. The insurance wrapper. Nobody explains this next piece is genuinely one of the most under-discussed tools in serious wealth planning. Using life insurance as an investment chassis, not just a death benefit. Permanent life insurance policies, and at the very top end, something called private placement life insurance, or PPLI, allow cash value inside the policy to grow on a tax-deferred and, in many structures, tax-free basis. The policy can hold a diversified investment portfolio inside it, growing for decades, and because of how life insurance is taxed under current law, that growth can often be accessed or passed to heirs without the same tax drag that a normal taxable brokerage account would face. It's not a tool exclusively for billionaires. Middle-class families have used basic versions of permanent life insurance for similar reasons for generations. But at scale, PPLI structures have become a quiet staple of ultra-high net worth and family office planning specifically because they combine three things: old money cares about most, tax efficiency, asset protection in many states, and a vehicle that naturally aligns with a multi-generational time horizon, since life insurance is, by definition, designed to pay out upon someone's death and transfer to the next generation. Combine an insurance wrapper with a dynasty trust, and you get a structure that's been quietly used by sophisticated wealth planners for decades. A vehicle that grows tax efficiently, sits outside the reach of most creditors, and transfers across generations with minimal transfer tax friction. It's not glamorous. It will never trend on social media, but it's been one of the steadiest tools in the old money toolkit for a very long time. The human factor, why most fortunes still fail. Now let's circle back to the Vanderbilts, because this section might be the most important one in the entire video. And it's the part that has nothing to do with asset allocation at all. There's an old saying that exists in some version in nearly every culture on Earth. In America, shirt sleeves to shirt sleeves in 3 generations. In England, clogs to clogs in 3 generations. In China, rice paddy to rice paddy. In Italy, from the stable to the stars and back to the stable. Every one of these proverbs describes the exact same pattern: wealth created by one generation, maintained by the next, and lost by the third. And the data backs up the saying more than most people realize. Research cited by wealth management firms, and even covered by the CFA Institute, consistently points to a striking pattern. A commonly cited estimate suggests roughly 70% of family wealth is lost by the second generation, and somewhere around 90% is gone by the third. even researchers who are skeptical of the most dramatic version of this statistic. Some trace its origins to a single, decades-old study, generally agree the underlying pattern is real. Financial sophistication and discipline are far harder to inherit than money itself. The Vanderbilts are the textbook case. Cornelius Vanderbilt built the fortune through ruthless, hands-on business discipline. His son, William Henry, actually doubled it. But by the third and fourth generations, the family had drifted entirely away from the habits that created the wealth in the first place. They competed with each other to build the largest mansions in New York, threw parties with literal hundreds of thousands of dollars in flowers, and almost none of them showed any real interest in running, growing, or protecting the underlying businesses. There was no unified estate plan, no trust structure locking up the core capital, and no system for teaching the next generation how to actually manage what they'd been given. New estate and income taxes, introduced in the early 20th century, combined with the Great Depression, finished the job. By 1947, every single Vanderbilt mansion on Fifth Avenue had been demolished. Compare that to families that have stayed wealthy across centuries, and you'll find a consistent pattern that has almost nothing to do with their specific investments and everything to do with governance. Family meetings, financial education starting young, clearly written values and expectations, professional trustees who aren't emotionally entangled with the family, and structures, like the trusts we discussed earlier, that physically prevent any one generation from blowing through the entire principal in a single lifetime. This is the piece almost nobody talks about when they cover how the rich invest. It's not really about finding a hidden secret asset class. It's about building a system, legal, financial, and psychological, that's specifically designed to survive human nature, generation after generation. Old money isn't smarter than new money. Old money simply built better guardrails. How to actually use any of this? So where does that leave someone watching this video who doesn't have a family office, a Dynasty trust in South Dakota, or a Picasso on the wall? Here's how these principles scale down. Think in decades, not days. The single biggest psychological edge old money has isn't a secret asset. It's patience that's been culturally reinforced for generations. You can build that discipline yourself by deliberately choosing a time horizon and refusing to react to short-term noise. Add at least one asset class that isn't correlated to the stock market. That could be farmland or real estate exposure through a fund, a small allocation to physical assets, or simply diversifying across asset types rather than concentrating everything in equities. Use legal structures, even simple ones. You don't need a perpetual dynasty trust to benefit from basic estate planning. A will, a revocable trust, beneficiary designations, and clear instructions can prevent the kind of chaos that quietly erodes far more ordinary family wealth than people realize. Treat insurance as a planning tool, not just a safety net. If it fits your broader financial picture, talk to a licensed professional about whether permanent coverage makes sense for your goals, not just term coverage for risk protection. And most importantly, talk to your family about money. The single biggest predictor of multi-generational financial failure isn't a bad investment. It's silence. Families that survive wealth across generations are almost universally families that talk openly about values, expectations, and money long before anyone has to. None of this requires being a Rockefeller. It requires borrowing the mindset, preservation first, patience always, structure over impulse, and applying it at whatever scale your life actually is. The Vanderbilts had more money than almost anyone in human history, and it still wasn't enough to survive 4 generations without a plan. Meanwhile, families with a fraction of that wealth, armed with land, trusts, patience, and a system built to outlast any one person's bad decade, are still standing today, centuries later. That's the real old money portfolio. It was never really about being secretive. It was about being structured, patient, and boring in exactly the right ways. If this video gave you a new way to think about wealth, hit subscribe. This channel breaks down exactly how financial systems like this actually work piece by piece, with real data and real history, not hype. And if you want a deeper dive on any single piece of this, dynasty trusts, farmland investing, or family governance, drop it in the comments, because that's exactly what's coming next. Thanks for watching. I'll see you in the next one.